HUL just came out with its third quarter numbers. The management is addressing the media, so let's cut across.
To more than rupees 10,000 crores. Net profit at 7,410 crores grew 14%. Let me now talk about our new royalty and central services arrangement with Unilever. Our current agreement, which was signed in 2013, grants HUL the right to use Unilever-owned trademarks, technology, and gives access to central services by Unilever Group. This arrangement has equipped HUL to meet emerging consumer needs with agility and win in the marketplace. During the contract tenure, HUL doubled its turnover and improved EBITDA margin by circa 1,000 BPS, creating superior value for all our shareholders. In view of the current agreement expiring, Unilever has requested HUL for a review. Unilever remains committed to support HUL through dialed-up access to faster innovation, superior products, technology, and capabilities. HUL board has approved new royalty and central services arrangement effective 1st February 2023 for a period of 5 years after detailed due diligence led by HUL senior management and guided by HUL's audit committee and board. The board also took into consideration an independent external benchmarking which indicated that the new arrangements continue to be competitive versus comparable transactions. The arrangement provides for an 80 BPS increase in the effective rate from circa 2.65% to around 3.45% of turnover. This increase will be staggered over a period of 3 years. The new arrangement is subject to appropriate regulatory approvals. Now moving on to our outlook. In the near term, we remain cautiously optimistic. If commodities were to remain where they are, we believe that the worst of inflation is likely behind us. This augurs well for FMCG industry and should aid in gradual recovery in consumer demand. Having said that, we must be mindful that year-on-year inflation is still high, and so we expect growth to continue to be price-led. We will continue to manage our business dynamically with focus on ensuring right price-value equation for our consumers and building back gross margins. We will keep investing competitively behind our brands, leading to a step up in A&P investments. We remain focused on delivering 4G growth that is consistent, competitive, profitable, and responsible. With this, I complete my prepared remarks, and now we can take questions.
Thank you, Ritesh. Mangalam, would you like to go first, please?
Yeah. Yes, sir. Thank you so much for detailing the outlook as you see it, and congratulations on what was a resilient performance in a challenging environment. The joker in the pack this time around was the royalty arrangement. So before I speak about demand and the way you see it, just wanted to know that this 80 basis points improvement or increase in the royalty that you will be paying to the parent, is there any way that there could be you going back on that if shareholders do not like it? Just wanted to know about that. And then you can obviously talk about the operating environment with regards to whether you view recovery to be gradual or will there be a spurt given the sort of decline that we're seeing in inflation, and how much of the raw material savings will be plowed back into advertisement, and do we see margin improvement from here on? So on the demand environment, operating environment is one, and the other one is with regards to royalty.
So Ritesh, let me talk about the demand.
Sure.
And then you could pick up on the other thing.
Sure.
Mangalam, first is my greetings to all your viewers. If we were to look at the preceding quarter, the September quarter, and the MAT numbers, then broadly, if we remove the decimal points, here I'm talking about the market growth. The value growth was about 6% and the volume growth was -6%. So we are talking about the difference between the two is the price growth. What we have seen in the December quarter, that the value growth has moved from 6% to 8%. And this has been driven primarily by volumes where the decline has come down from -6 to -4. Now this augurs well. Yeah. Now whether it is an established trend, and this change we are seeing both in urban and rural market. And rural market, as you know, the decline was far more accentuated. So even the improvement has been bigger in rural as compared to urban. And if this trend remains, then it certainly augurs well for the industry. So that's on the overall demand is concerned. Now, there is another aspect which I want to cover with you, which is inflation. You know, when we look at inflation, and we have often referred to net material inflation, and net material inflation, if you look at for the last 6 quarters, September quarter 21, December quarter 21, the net material inflation was about 11%, which was still very high compared to the prior periods. But then in 22, it moved to 16%, 20%, 22%. But the good bit is in the December quarter, it has come down to 18%.
Right.
So what we are seeing is that the inflation is still at a very high level. 18% NMI is very high, but it has stopped increasing, and the trend is now moving southwards. Again, the volume growth and the inflation will be inversely correlated. If the inflation goes down, I believe the volumes will pick up. So that's on the macro environment.
Yeah, let me pick up now, Mangalam, your question on operating environment. So overall, Sanjeev mentioned that commodity inflation is moderating sequentially. What are the implications of this? There are 3 implications. Number one, in short term, as commodities are moderating, we will focus and build gross margins back. In the current quarter, as Sanjeev mentioned, when sequentially NMI reduced from 22% in September quarter to 18% in current quarter December, we have seen in that period, we have improved our gross margin sequentially by 170 bps. For us, that's a first focus area. The second focus area is also to ensure a right price value equation. Now, commodities, of course, are overall moderating, but there are multiple different dynamics. Where if I look at December quarter, home care and HFD, in these portfolio, we've seen sequential commodity increase overall, the impact, including the impact of US dollar strengthening. In these categories, in December quarter, we took sequential price increases. But when I talk about vegetable oil, which has seen meaningful correction, and hence in December quarter, we have taken price corrections and price decrease in vegetable oil, like we have done for the last couple of quarters on tea. So skin cleansing pricing linked to vegetable oil price coming down, we have taken price decreases in our soaps portfolio and in our tea portfolio. Now, if I put all this put together, the focus for us continues to remain that to keep growing consumer franchise and keep our margins in a healthy range. So that's on the operating environment. The second element of that is on price growth. And as you've seen in the current quarter, we have declared a total growth of 16%, which has 5% volume growth, and hence inferring of that is 11% growth in price. What we see from here on, the price growth will be lower from here on going forward as we are seeing commodities moderating. And to Sanjeev's point, the way the volume and the price equation for the market will settle down, that's something that we have to see in times to come. And lastly, a question on royalty. Royalty today, as we announced, has been approved by the board. Royalty and overall the arrangement has multiple components. It has a component of royalty, both for the trademark and for technology. It has a component of also central services. Now, these arrangements, as I mentioned, are subject to appropriate regulatory approvals. But today what we have is approval from the board, and that's the number that we have shared. Overall, an increase of 80 BPS, and this 80 BPS increase will be staggered over the next 3 years.
Yeah, so I just wanted to follow up on that itself. Is there any way that, say for instance, the street does not like that, is there any way you will look back at this royalty, or currently it's cast in stone? Or should I look at it this way, that despite the increase in royalty, you are so optimistic about the performance going forward that it won't impact, the operating performance of the company going forward?
So let me, Mangalam, pick up your second question.
Right.
Yeah, the last royalty increase and the service fees increase, all this took place in 2013. And during this period, 2013 to now, we have doubled our turnover and we improved our operating margin by nearly 1,000 pips.
Right.
Now, we have a symbiotic relationship with Unilever, and we have access to great brands, we have access to great technology, product superiority, is great managerial, technical services that come to us. So these are of immense benefit to us, which enables us to create the competitive edge that we have in the market.
I just read it in a way that this is an arrangement for the next 5 years, and in the next 5 years, maybe your revenues grow by 50% and margins improve by 500 basis points going by the past. But then that's again on a lighter note. Back to you guys. Thank you.
It's a wrap on this edition of Business 360. Many thanks for watching, but stay tuned.